Yeah. Good afternoon, everyone. This is Terry Horan, and this is welcome to our ninth webinar during this period of uncertainty. We have our usual experts in the room: Paul Carl, Matt Antonucci, Greg Hornschmeyer, David Templeton, and myself. The subjects today will include the market and it's what's happened this week, questions around Social Security that we've been fielding from clients over the past couple of weeks, and a small Washington update as it relates to Section 125 plans. Our fundamental at Horan for the week is check your ego at the door, and that's certainly what we're going to have to do because in the previous 8 weeks, the market's been going up each and every week, and this week it's dropped 2%. So we have to check our ego at the door. We are still 29% off the intraday low of March 23rd as of today. And if you look over the last 12 months and include dividends, we're slightly ahead of the S&P and where it was 12 months ago. So with that, to start, David, why don't you take it away?
Okay, Matt's going to start with the slide there, Matt.
All right.
Yep, so just a quick update on the market here. Just kind of piggybacking on what Terry said, we're looking at a familiar chart for those who have been regularly tuning in at the S&P 500 going back to November. And as of the close yesterday, the market's down 11.7% year to date. We're off 15.76% from the record close on February 19th. But as Terry mentioned, we've rallied significantly from the March 23rd low. And it's been an interesting rally. So, you know, along the ride here, sentiment amongst individual investors is still quite negative. And we haven't seen broad participation amongst some areas of the markets like banks or industrial companies. And money market cash balances are still quite elevated. We're sitting at $4.79 trillion still in money market funds. And I think it's fair to say that it's been, you know, a welcome but maybe uncomfortable rally for a lot of folks. So like Terry mentioned, stocks are down about 2% on the week before today. We still have about 4 hours to go to the close, so we'll wait to update that. But this morning we had a number of economic data points coming to hitting the news wires. Notably, you know, retail sales came in down 16.4% in April. Industrial production dropped 11.2%. So still some negative data coming through the economic numbers. And like we mentioned, we've had a big run here, and there's definitely some reason to expect some weakness or sideways action in the market given the rallies that we've experienced. But states are opening up. We'll see how that goes. And you know, as we look out 6 and 12 months, we still remain positive, but certainly going to be some more volatility probably over the near term.
What's interesting, Matt, you talked about the retailers there. So it was kind of interesting to see what's working today. Would you agree with that?
Yeah, it is interesting. So, you know, some of the retail numbers, when you dig underneath the surface, a lot of the you know, clothing was down almost 80% month over month, but online sales were up 8.4%. But the exact opposite when it comes to performance in the market of that has happened today. So a lot of the online retailers are actually down today, but the more brick and mortar type stores are up today.
Like Dillard's and even some of the recreational, the RVs and the boat stocks. People are spending money. We're thinking, it seems they're more, at least the market's anticipating they're going to start spending some discretionary dollars maybe.
Yep, that could be the case just as the market looks forward, as states start to open up, expect a rebound from the numbers that we've already gotten here. So,
Matt, the news on retail shops and stores over the next 5 years isn't particularly good.
It's not, and we think it's probably going to, it's something that's already been occurring, you know,
yes,
with the shutdowns.
Amazon started this cycle.
Yes. You know, before the shutdown occurred, though, you know, the U.S. has been over-retailed for a very long time, and it's probably just this shutdown's accelerating some of what has already been happening, Amazonification, if you will.
Good. All right. Are we going to switch to Social Security?
Yep.
Michael Hermes, are you on the call?
Yes, I'm here, Terry.
All right. Take us through a couple of interesting slides on this.
All right, great. So one of the questions with kind of the mass layoffs and furloughs we've been getting a lot is, should I retire now? And so a lot of people might be forced into early retirement. And one of the questions I get a lot is in regards to their Social Security and what they should be doing with their Social Security benefit, if anything at all. And so every single year, the Social Security Administration releases their annual fiscal results. And what you're seeing here on this slide is the 2019 fiscal results. So about every single year, about $1.06 trillion comes into the system, the Social Security system, via taxes on your paychecks. And then every single year, about $1.60 trillion leaves the system in the form of benefit payments. So there's not really a big surplus of money coming into the Social Security system. And one of the big concerns is Social Security going to run out of money? And so it's actually projected that this year, 2020, there's no more surplus in the Social Security system. So going forward, every single year, they're going to have to start dipping into their trust fund reserves, which sit at about $2.9 trillion, to continue paying beneficiaries 100% of their payment. And so it's projected that by the year 2035, that trust fund is depleted to zero, and everyone is going to get roughly 79% of their benefit payments going forward. So instead of getting the full 100%, come year 2035, everyone's going to get about 79% of their benefit payment going forward. There's a couple ways, some pretty simple ways, in fact, that we think Congress could fix this. In Congress right now, there is a bill. It's called the Social Security 2100 Act. And if this gets passed, everyone will get 100% of their benefit payment through the year 2100. So it will fix that shortfall. And the way that they're presenting it in the bill to fix the system is to increase the amount that is subject to Social Security tax and increase the overall tax rate. So those are the two big ways that they're planning on fixing the system currently in Congress. I wouldn't be surprised if they start to introduce other legislation that starts to push back everyone's normal retirement age when they file for Social Security. So currently, the last Social Security, the full retirement age, the latest full retirement age for individuals born after 1960 is 67. They'll probably start to push that back even further, so that if you're born after, say, 1970, the full retirement age will be 68 or 69. So, but keep your eyes out on Social Security Administration and the news in regards to the Social Security 2100 Act. And so where does that leave us? A lot of people getting ready to retire now, though, that won't really impact them for the next 15 years, and they want to know what to do with their benefit now. And so especially with the market taking the downturn that it did. So before you go into retirement, you should have about 40 to 60% in stocks and 40 to 60% in bonds. So that's kind of the industry standard when it comes to a typical retiree investment portfolio. And so right now, because interest rates are so low, it makes sense to fund those early years of your retirement out of the bond portion of your investment account, because you wouldn't anticipate that earning as much. And what that does, and continuing to delay Social Security, what that does is twofold. It allows your stocks to recover over time, and it allows your Social Security benefit to continue to increase at a guaranteed rate of about 8% per year. So kind of breaking that down and looking into the numbers a little bit more specifically. So if you just put it in perspective today, the 10-year U.S. Treasury is currently yielding somewhere around 0.7% per year. So if you just buy a 10-year U.S. Treasury and you hold that for 10 years, you should make about 0.7% per year on that money. When you start to consider things like inflation, which is at about 0.3% on a 12-month year over year, your real return that you're actually making on your money is only about 0.397%. So you're really not making any money by holding on to any sort of safe, stable treasuries inside of your investment portfolio. And so fund those early years out of your fixed income. And what that does on the other end, if you compare that to delaying taking Social Security, like I alluded to before, you're going to get a guaranteed increase of 8% per year on your benefit amount. Also, Social Security will increase with inflation, It doesn't increase with the inflation number known as CPI-U. It increases with what's called CPI-W, which is a different way of looking at inflation for the workforce. But your Social Security payment will increase some by inflation. So you're getting that added benefit there. So if you take your 8% guaranteed rate of return on your Social Security, you add the inflation, CPI-W to 0.1%, and then you subtract your CPI-U of 0.3, you're going to get a guaranteed real rate of return of 7.8% in today's market, which I think is pretty good. So that's really what we're telling clients to do at this moment, is to continue to delay taking Social Security for as long as possible, and you'll get a better rate of return than on your kind of treasury securities or fixed income securities inside of your portfolio.
Michael, that was a brilliant explanation, and it was brilliant because even I understood it. And I really appreciate you going through that, given that I'm in one of those delicate ages as you're talking about. I would like to ask you a question on that, though. If I recall correctly, if I have a spouse, my spousal benefit, once I take mine, does not increase through that period of time between 66 and 70. Am I correct on that?
Yeah, that is correct. If you are planning on taking a spousal benefit instead of your own personal retirement benefit, after your full retirement age, we'll say call it 66, that does not continue to increase 8% per year.
Yeah.
So if you're planning on taking that spousal benefit, it might make a difference to the strategy here.
Yeah. And not to overly complicate the situation, Michael, but isn't there also another strategy? Is there a strategy still available that I can take off my spouse's record for a period of time and then swap to my record, or is that gone now?
Yeah, that is correct. If you or your spouse were born on or before January 1st of 1954, you can file what's called a restricted application. Essentially what this does is you get a free spousal benefit from Social Security, and your personal retirement benefit will continue to grow 8% per year until age 70, so that when you turn age 70, you can flip from your spousal benefit to your increased retirement benefit.
So you have to be born before 1954 to make that happen?
Correct. On or before January 1 of 1954.
That's helpful.
Terry, you're lucky there.
Yeah, and you have a situation there's a small quirk in the Social Security rules, is it not, David?
There is. If you're born in 1960, and it's a pretty complicated formula, but they calculate your benefit based on kind of an average benefit for the whole Social Security system. And one of the years included in that calculation for people that are 1960 is this year. And with income being down, it's estimated that people born in 1960 are going to see a decline in their benefit if there's no changes of about 15% when they retire because of how the averaging works. So it's pretty
15%.
15%.
Wow.
So we'll see if you're born in 1960, contact your congressman.
Absolutely. That was a difficult year anyway.
Yeah, right, exactly.
Difficult year anyway. Well, that's great. Michael, thank you for that explanation. Well done. And David, thank you for your age 60. It's interesting.
I'm helping you out.
Yeah, thanks. Y'all are. Paul, there's been a little movement on a very interesting benefit called the 125 plan, the health savings accounts and the dependent care accounts. Maybe you can just do a high-level explanation of what's changed here.
Terry, I'll be happy to. I'm glad to report that the IRS was active this week. On Tuesday, they issued a couple of notices, 2020-29 and IRS notice 2020-33. So to talk a little bit about 2020-29, what it really boils down to is certain normal irrevocable changes in Section 125 plans are permitted on a go-forward basis. A couple of examples are with regard to employees who may have initially declined coverage for health benefits.
What are Section 125 plans?
Health plans.
So
Health savings accounts, you mean?
savings account.
savings account.
Okay.
So, and so basically, yeah, the employee, can, if he initially declined coverage, can elect coverage. He can change some coverages around and,
What these are contributions to a fund to supplement coverage. And so the health savings account supplement is a fund that you build to pay off deductibles or co-insurance costs or uncovered medical benefit things.
Right.
So, and then you also have a separate account for being able to pay for childcare. And money put into that is deductible, but typically those contributions are irrevocable through a plan year. And
use it or lose it. Use it or use it.
And use it or lose it. So under 2029, those irrevocable changes, as long as the employer will allow it, have now become revocable. So you can make those changes through the year. And people may want to do that because they don't have child care expenses because everybody's living at home, and they may have to postpone elective surgeries. And so this notice is welcome news to a lot of people, that they can make revocable changes in those contributions to those accounts. But the issue is the employer has to allow it. And so you have to check with your employer to see if it's allowed. Then, Paul, tell us about the 2020-33.
Yeah, so that simply says some additional carryover relief for healthcare flexible spending accounts. So instead of forfeiting unused healthcare flexible spending accounts, they're extended
Till the end of the year.
through the end of the year.
So it's an interesting subject. We have a blog on it on our website. And if you or if any of your children or friends are impacted by Section 125 plans, they're going to want to know this information and plan accordingly. Because it is a liberalization that we were not anticipating that the government would do. With that in mind, I think we're going to close out for the day. We anticipate that Matt and David and Michael Hermes will do something better in the market next week. And what we're going to do is talk about winners and losers in the equity markets next week as we come out of this period of uncertainty. What, in our opinion, who will be the winners and who will be the losers. So thank you, Paul, David, Mark, Matt, and Gregory, and see you next week.
Thank you.
Thank you.
Thanks.